The Dow just hit an all-time record high of 52,900.07 last week. I mean, we are in completely uncharted territory.
Yeah, but at the exact same time, you look under the surface, and Wall Street's ultimate fear gauge is flashing this bright red warning.
Right, and that is exactly the setup we are looking at in today's deep dive. It is Sunday morning, July 5th, 2026.
And the market is obviously closed for the holiday weekend, but we are prepping you for tomorrow morning's opening bell.
Exactly. We are looking at a stack of institutional strategy notes today, and our mission is to give you an exclusive institutional-grade preview of the upcoming trading week. We need to figure out what the smart money is actually doing.
Because that contradiction, the fear gauge versus the record highs, that tells you something massive is shifting under the hood.
Okay, let's unpack this.
Right.
How can the market be terrified and breaking records at the exact same time?
Well, it comes down to a highly polarized environment. To understand where we're going tomorrow morning, we really have to dissect the bizarre price action we saw right before the holiday break.
You mean the divergent weekly breakout?
Right, that's what institutional desks are calling it. Because you look at the headline indices and you think, oh, everything is just a massive risk-on party. But you zoom out and look at individual sectors on the weekly time frame, and it's a totally different story.
Divergent is definitely the word. I mean, let's just look at last week's close for a second. The S&P 500 pushed up 1.8%, closing at 7,483.24.
Yeah.
And the Dow surged a full 2% to that record, 52,900.07. If you just read those two numbers, you'd think there was literally zero fear in the market.
But then you look under the hood at Thursday's action right before the bell, the NASDAQ actually fell 0.8%.
Yeah, we saw really aggressive profit-taking hitting the AI and semiconductor stocks. I mean, Micron dropped 10.6%. Corning fell by 13.6%.
Which is a violent rotation out of the market's biggest darlings.
Exactly. So what was the actual catalyst for that?
It was Thursday's shockingly soft June jobs report. The consensus on the street was 115,000 jobs. But instead, we only added 57,000.
Wow, so less than half of what they were estimating.
Right. It was a massive miss, even though the overall unemployment rate held at 4.2%.
But wait, if the economy is abruptly slowing down like that, I mean, why did the Dow shoot up to a record high?
Because we are firmly back in a bad news is good news environment.
Right.
When the labor market showed that kind of weakness, it instantly cooled down interest rate fears. Wall Street saw that 57,000 number and thought, okay, the economy is cooling, inflation might cool, so the Fed won't have to hold rates as high for as long.
Ah, I see. I sort of look at this market right now like a relay race. For the last year, mega cap tech has been running the anchor leg, just carrying the entire index.
They've been sprinting.
Right. But looking at Thursday's sell-off, tech looks completely exhausted. So the question is tech dropping the baton entirely, or is this just, a healthy handoff to the other 493 stocks?
What's fascinating here is that the volume profile data points to a really healthy handoff. This wasn't a panicked flight to cash at all.
They weren't just liquidating and hiding.
Exactly. It was a targeted sector rotation. Money flowed rapidly into small caps, into financials, into mid caps. The S&P 500 advanced decline line actually hit fresh all-time highs on Thursday.
Which confirms the breadth is widening. Thousands of individual stocks are finally catching a bid, even as the AI giants stumble.
Yeah, the foundation is actually getting stronger. But because money is rotating so violently, we have to know where the technical guardrails are.
Right. If you were setting up your screens for tomorrow morning, you need the exact lines in the sand. So let's start with the S&P 500.
The primary line in the sand is the 7,350 support level. We tested that really last week. Monday's low printed at exactly 7,348.888.
A buyer stepped in.
Big time. Institutional buyers defended that level aggressively and pushed it all the way to 7,540.75 by Thursday. So 7,350 is the critical pivot. We lose that on a weekly closing basis. The whole bullish trend fractures.
And what about the NASDAQ 100? Because with tech taking such a beating, that index has to be under pressure. I mean, it barely held its 50-day moving average, which is right around 29,143.
It is under immense pressure. On Thursday, we saw heavy institutional block selling near the 30,000 mark. Large funds were just locking in profits.
But we also saw those passive algorithmic buy orders step in near 29,100, right?
Exactly. The passive index funds had to step in and buy to cushion the fall, largely because they are front-running the SpaceX index inclusion on Tuesday, July 7th.
Right. Active traders know the passive funds have to buy SpaceX on Tuesday, so they buy the broader index early.
Yeah, the rebalancing volatility there is going to be intense. But Honestly, the ultimate macroeconomic compass for tomorrow morning isn't a stock chart at all.
It's the 10-year Treasury yield,
Exactly.
which closed the week at 4.49%.
Right, and that 4.49% is basically sitting on the edge of a cliff. The absolute key pivot here is 4.50%.
Why is that specific number so important for equities?
Because if the 10-year yield breaks cleanly above 4.50%, it triggers an immediate valuation squeeze on high multiple tech stocks.
I always look at bond yields like gravity. If you buy a high multiple tech stock, you are paying a premium for profits 10 years down the road.
Yeah, future earnings.
But a government bond is risk-free money today. So if that yield hits 4.5%, the gravitational pull gets heavier. Waiting 10 years for an AI startup to turn a profit looks terrible when you get a guaranteed 4.5% right now.
That gravity analogy is perfect. When yields rise, future earnings are mathematically worth less today. But if the yield rejects 4.5% and slides lower, gravity lessens. That is a massive green light for risk-on assets.
So if 4.5% is the boiling point, what economic data on the calendar this week is going to turn up the heat?
We have two massive red folder events. The first one hits tomorrow morning, Monday, July 6th, the ISM Services PMI for June.
Which is huge because services are, 80% of U.S. GDP?
Exactly. May's print was solid at 54.5, but the detail you have to watch tomorrow is the prices paid subindex. In May, it was blazing hot at 71.3.
Right, showing sticky inflation in services.
Yeah. If it comes in hot tomorrow, yields will absolutely spike through 4.50 and growth stocks will take a hit.
But here's where it gets really interesting. Tomorrow's data is just the appetizer. The main event is Wednesday, July 8th, with the June FOMC meeting minutes.
Along with the RBNZ rate decision globally, yeah. But Wednesday's Fed minutes are critical because it's our first look at the new Fed chair, Kevin Warsh.
Right. We know they held rates at 3.50 to 3.75%. But Warsh is radically changing the regime over there.
He essentially threw out the modern central banking playbook. He slashed the statement down to just 4 paragraphs.
Just 4 paragraphs. And he completely eliminated forward guidance, right?
Yes. And on top of that, he dropped his own dot on the dot plot.
I mean, for an active trader, that is a huge culture shock. Dropping the dot plot and forward guidance, that's the Fed basically refusing to hold the market's hand anymore.
Exactly. He's saying forecasting rates a year out is pointless.
I liken Warsh to a ruthless new CEO coming in. The old CEO handed out snacks and told everyone the exact quarterly goal so they felt safe. Warsh walks in, rips up the employee handbook and says, "We communicate through results now. Figure it out."
It's a total vibe shift.
It is. But the danger is, are markets ready to fly without the Fed put safety net?
Well, if we connect this to the bigger picture, Wednesday's minutes will show if the rest of the committee is united behind this hawkish stance. Because if they are, rates are staying higher for longer.
Which is incredibly toxic for small caps, the IWM index.
Yeah, because they are drowning in floating rate debt.
Right, their loan payments adjust to the Fed rate, so their margins just get crushed. And it's also toxic for regional banks, the KRE, right?
Absolutely, because they are sitting on those massive underwater bond portfolios from the zero interest rate days. A hawkish Fed means those bonds stay underwater.
Wow. Okay, so we have ISM tomorrow, Warsh minutes on Wednesday, and then Friday, July 10th, Delta Airlines reports Q2 earnings, the starting gun for earnings season. Plus, we get China CPI, Germany CPI, and Canadian labor data.
Yeah, the China CPI is key for global supply chain inflation.
So, bringing this all back to the hook, the record high Dow versus the systemic fear. How are the big institutions placing their bets, and how do you avoid getting trapped?
Well, the sentiment divergence is insane right now. The CNN Fear and Greed Index is at 31.89 deep in fear, but the AAII retail sentiment is mildly bullish at 44.9%.
And this is all happening in July, which is historically the best month of the year for the S&P 500.
Right. It averages a 2.5% gain since 2005, no negative July since 2014.
So you have bullish seasonality, a record Dow, but deep systemic fear. Oh, and Citi is warning that roughly 80% of NASDAQ longs are currently offside.
Meaning they bought into the tech rally at much higher levels and are now trapped, just bleeding money.
And that setup is the perfect kindling for the pain trade.
Exactly. The pain trade is the market direction that inflicts maximum financial misery on the largest group of investors. Right now, it's twofold.
Okay, what's the first one?
The first is an equity squeeze higher.
Okay, let's synthesize this. What is the actual game plan for tomorrow morning?
First, watch the 7,350 level on the S&P. As long as that holds, the broadening rotation is intact. Second, keep your eyes glued to the 10-year yield,
4.50% is the boiling point.
Right. A rejection there is a green light. A breakout means you tighten your stops. And lastly, brace for the ISM PMI tomorrow and the Warsh minutes on Wednesday.
So what does this all mean? It means you are now armed with the exact same institutional blueprint as the Wall Street desks for tomorrow's opening bell. You know the gravity of the 10-year yield, the trap with those offside NASDAQ traders, and exactly how the fuses are wired for the Fed.
But this raises an important question, something for you to mull over as the price action unfolds.
What's that?
If the real pain trade is the market going higher despite the fear, what if the popping of the AI bubble doesn't destroy the market? What if the exhaustion of the tech sprint is exactly what we needed to finally force capital back into the neglected foundational sectors of the real economy?
Now that is a thought to take into the opening bell. If you understand the mechanics of where the money is rotating, you can still see the bones of the market. Stay sharp, manage your risk, and we will see you next time.